And good evening, ladies and gentlemen. How are you all doing on this wonderful, fine Wednesday evening? Tom said in here, he says, I cannot wait with two exclamation points. And so I asked my moderators, I said, should we start this thing for Tom? Because Tom just cannot wait. And I'm so happy that we can bring this evening to Tom. He's super excited about tonight's class, I guess. And tonight we are getting into candlestick trading part 2. So it's the second half of what we started in the last class, which of course we met with on Monday night. And here's what our agenda is going to look like today. It's actually a very full class. We're going to take a look over here, do a quick review of candlesticks that we've learned up until now. Then we're going to do a quick review of candlestick pattern. Actually, not a review, but an introduction into candlestick patterns. And then the rest of the evening, after we've gone through the patterns, whatever time we have left, we'll do practical application by going over to Trade Navigator and taking a look at the market, doing some pattern identification, and seeing how we might be able to theoretically set some trades up. Now, granted, we're not fully ready to set the trades up because we still have to get through indicators and some of the other stuff that's coming up next week, but we're certainly rounding the corner and getting you guys a lot of analysis tools. So let's do a quick review. In the last class, you learned that the candlesticks come to us from Japan, and specifically they come to us from the Japanese rice traders. Japanese rice traders back in the 1700s used candlesticks to help solidify price action, marking the open, high, low, and close. Of course, each candlestick represents a specific time period. You can have a candlestick that represents a day, a week, a month, or you can represent any of the intraday periods. And a candlestick is going to reveal the sentiments of the traders trading the stock. So when we look at a candlestick, we see how the traders are trading or what they're looking at. Let me say that a little bit better. When we look at a candlestick, we see the price action, the open, high, low, and close, and based on the formation of the candle, we get an idea of how the traders are feeling about that particular trade. Candlesticks mean the most when they occur in the right location, and we determined in the last class that that right location is, of course, a pivot area or a pivot point. It's either going to be a support or a resistance area, depending, of course, on which particular type of a formation we're looking at. All right, now we also discussed that there are two types of candles. We've got the black candle, which is going to be a bearish candle, and we've got the white bullish candle, theoretically bullish. In the case of the white candle, you represent a higher close than opening price. In the case of the black candle, we've got a representation of a lower close than opening price. Looking at the construction here of the candles as a quick review, of course, those candles represent the open, high, low, and close. Each candlestick contains a real body and a shadow, or upper and lower shadow. And the real body is going to represent the opening and the close price, whereas the shadow is going to represent the intraday high. That's the high shadow, or the upper shadow, and the intraday low. So just the real body, opening price, and closing price. And of course, the real body is the only part that changes color. The upper and lower shadows are always going to be a little black line, little vertical line moving up and down. All right, now that's your basic review of what we talked about in the last class. In the last class, we discussed several single candles, several single line candles, and talked about how they can lead us into early reversal signals. Tonight, we're going to get into this discussion of candlestick patterns. Candlestick patterns. So, what I want to do before we go too far, take a look at this picture, and I want you to tell me, is this trade set up bullish or bearish? Type it in. Ready? 1, 2, 3, go. Bullish or bearish? What do we have on this particular trade setup? And they're flowing in here. And I've got a good mix. I've got bull, bull. I got bear, 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 bearish, bullish, bearish, bullish, bullish, turning over to bearish, says Lauren. All right, so got a neutral one here from LM. But pretty good... pretty good variation, or pretty good mix up here, I should say. I don't have a specific statistic. I should have done a little poll. That would have been a lot easier, wouldn't it? Anyway, so bottom line, some of you think it's bullish, some of you think it's bearish. Now here's the question, why? Based on what you have learned so far, of course, some of you are retake students, so you already know the punchline here, but based on what you have learned so far, everything about this trade looks bullish. So anybody who says that it looks bearish based on what you've learned so far is jumping the gun just a little bit here because you really don't know. I mean, take a look at this picture. Based on what you've learned, what do we have? We have a gap. It's a bullish gap. Okay, we've got a trade that's been making higher highs and higher lows across the board. Okay, so thus far, you don't have any reason to be bearish on this trade. Your moving averages have crossed over bullish, and they're all moving at a fairly strong angle at this particular point in time. There's zero reason to be bearish. Now, based on the last class, you might have picked up the fact that there's a hangman candlestick here. So I could certainly give you that one. Yes, there's a hangman, and then it was followed by a bearish candle the next day. But come on, let's be honest. You can see a bunch of these inside of a formation, and it doesn't necessarily mean it's a bearish trade. So how do we know this is a bearish trade? And the answer, of course, is because there is a pattern here. And it's this 3-candle pattern that we're going to be talking about tonight called an evening star reversal. Now, if you did not know that pattern, and by the way, a lot of you who said it was bearish, it's because you knew the pattern, so you cheated just a little bit. But if you did not know that pattern, then odds are, based on what you have learned so far, you would have been thinking, hey, this is a great trading opportunity. Trade pulled back into my 10-period moving average, and there's a good chance that this thing is going to continue bullish because obviously, based on Dow theory, once a trend's in motion, we assume it's going to stay in motion until it's given definite signals of reversal. We do not have any kind of definite signals of reversal. But if you knew your candlestick formation, you might understand that, hey, this little 3-candle formation here suggests to me that this trade is about to turn over. And even if it's not a long-term reversal, certainly in the short term, there's a good chance it's going to reverse. And sure enough, what happened? Boom, it did reverse. This was actually yesterday on Baidu, and you can see exactly what happened. We moved from $130 down to $122 in just one day. So it was an $8 move that this particular little trade setup precipitated here, and essentially it wiped out the majority of the move that we had set up before, because if any of you were watching this before, there was your pennant pattern. We had set that trade up initially, and we actually traded all the way back down into that trade setup right in through there. And then today, actually, the stock continued gapping down. All right, so that was one example, and it is one example of how candlestick patterns can change the insight that you get into the trade. You would not have necessarily known that insight had you not known your candlesticks. In fact, most likely you would have missed that trade if you had not known what to look for in that particular pattern. All right, let's take a look at this pattern right here. What do you look at here? Whenever you look at this formation, bullish, bearish, or neutral? Go. Ready? 1, 2, 3, go. Bullish, bearish, or neutral? What do you have? All right. Neutral, neutral, bullish channel. Bull, bull, bull. Lots of bullishness in here. Few neutrals. I don't have anybody saying bearish, I don't think. So pretty much everybody is either bullish or neutral. A few people saying we've got a channel, and some of you saying stair-step trend. No, it's definitely not stair-step or trend. But based on what you've learned so far, again, everybody who said bullish channel or just a sideways channel, this would be what you would assume that this particular formation should be shaping up as. If you looked at this and you could sit here and say, well, I do have higher highs and higher lows. So yes, in that sense, we are in a bullish move. But it's a very, very low slope. Look at your moving averages. Your moving averages are pretty much just going flat here. They're kind of cycling up and back down. And, you know, it's kind of like a slow wave here until the very end when they are starting to separate. But more importantly, we've got this particular candlestick formation, which we're going to talk about tonight. And as you look at that candlestick formation is a candlestick continuation pattern that suggests this trade is about to break out bullish. In fact, this formation is so consistent that it really says that this trade just broke out bullish on that day, and the next day it should continue. Well, sure enough, where did we go? Over the next several days, we continued trading higher and higher, and this trend did break out, and now you can see the moving averages as they solidify and they confirm that trend. So again, what this really sets up for you and what it shows you is it shows you the power of a candlestick pattern. A candlestick pattern is a formation that occurs with your candlesticks, which when they occur, most of the time they play out in a specific way, much like your chart pattern. And so what we're watching for with these candlestick patterns, there's only a handful of them that we're going to be talking about. And what you're looking for is you're looking for the patterns to shape up and to form, and then you basically just set your trades up, and hopefully, you know, your other indicators and other chart patterns and support and resistance and everything else that we've been talking about, hopefully they will all play into the trade as well. But from a basic standpoint here, these candlestick patterns, very, very strong, very good addition to your confirmation, and help us have a much higher probability of understanding the direction of a trade. Now, in the case of that first pattern that I showed you, in that case, that's actually not a confirmation of a direction of a trade. It's a big warning. And so we're going to look at a lot of those tonight. We call them early reversal signals. And those are the first signal that you're going to have of a potential reversal. And so anytime you see an early reversal signal, I suggest that you tighten stops or even exit the trade. And you know, you don't want to risk a whole lot of capital when you're flirting with a whole bunch of early reversal signals. All right, so let's get into some of these individual candlestick patterns. All the patterns we look at tonight are going to be 2 candles or more. 2 candles or more to create a pattern, okay? So 2 candles or more will create the pattern. Individual candles or single candle lines, 2 or more candles creates a pattern. Of course, candlestick patterns are much like your individual single candle lines. They're going to mean the most when they occur in the right location. Candlesticks are most powerful when we combine at least 2 or more. They mean the most when they occur in the right location. And single candles show sentiment. That's what we talked about in the last class. Single candles show sentiment, but 2 or more candles reveal patterns of behavior. And that's what we're watching for tonight. All right, as I'm about to get into this first slide over here, I'm realizing that I forgot to mention something. As I was putting the slideshow together, I wanted to insert a slide that I totally forgot to put in here. So I'm going to insert it. And I'm going to insert it by going back so I have some room to write here. All of these 2 candle formations, and let me just write some notes here, okay? So 2 candle formations, 2 candle formations. You guys can write this somewhere in your notebook there. 2 candle formations are going to consist of alternating colors. Okay, so in a bearish swing, the first candle will be a black candle, and then the second candle will be a white candle of some sort. And so all of the formations, all the 2 candle formations that we're looking at, this particular color coordination has to happen the way that I'm going to present them to you tonight. Okay? In the case of a bullish trend, it'll be the opposite. You'll be in the trend, you'll have a white candle, and then you'll have a bearish candle or a black candle that shows up next to it. And so it's alternating colors. So the first candle of the formation looks like it's a continuation of the trend. The second candle looks like it's a sudden reversal of the trend. And so all of the formations that we're going to look at tonight that are 2 candle formations are going to take on this basic formation. Okay, so I wanted to point that out before we get going too far. All right, now that we've done that, let's look at the first formation, which is what we call a bullish piercing pattern. If we can get over there, there you go. The bullish piercing pattern is a 2-line candle formation. It's going to occur during a downswing. Now, just as a quick reminder, last class we talked about what is the nature of a swing. Does a swing have to be a full trend? The answer is no. It could be a fairly small swing. It could just be a few days in order for it to constitute a downswing. So this particular pattern is going to occur during a downswing. If it's part of a downward trend and it's at the bottom of that downswing, it's even better. But it's going to just, all it requires is that it's a downswing. It's going to consist of a dark candle followed by an open white candle, like you see right here. Now watch this right here. The first day will be a good-sized black candle. We will gap down. In fact, I left that out of here. Forgive me. This is the first time I've taught through these new slides. We will gap down, and then the white candle will pierce at least halfway through or halfway into the first candle. Okay, so we'll put halfway right there. It's got to come into the first candle at least halfway. We're going to have a little gap down here, and then it's going to pierce into that candle at least halfway. This is a bullish reversal signal. It's especially strong when you see it happening at a resistance, or at a support level, I should say. When you see it happening at a support level, it's a very, very strong signal. And you get the idea of it right there. We're in a little downswing. We have a good-sized black candle. The stock gaps down on the open, but it fills within the day. And we end the day with a white candle that pierces at least halfway into that first candlestick formation. Okay? That is your bullish piercing pattern. Now, what I'm going to do tonight, a little bit different than the other night, I'm going to actually go through all the patterns, and then we're going to go over to Trade Navigator and find examples and put them into full practice. So I'm not going to waste all of our class time looking at full in-context examples. This is the basic formation. Your notebooks have the formations, and then you can practice with those ideas mixed with what we're going to do at the end of class. All right, dark cloud cover is kind of the inverse idea. This is a two-line pattern. It's going to occur during an upswing. You're going to have a better than average size white candle. The stock is basically going to gap up. Again, I left that bullet point out of here. I'm so sorry I left that bullet out. It's a very important one that I forgot to put in there. Gap up, and then the second candle must push down at least halfway into the first white candle. Okay, so again, we'll just kind of say halfway into the real body of the first day's white candle. This is a very strong bearish reversal signal, especially if it happens at resistance. When I say very strong, it is a very, very strong. The dark cloud cover is a very, very strong pattern. We actually just saw one of these occur on Apple yesterday. We'll go look at all these again when we get into individual trade analysis here in just a few minutes. All right, that's the dark cloud cover pattern. So I'm kind of going through them, and then we're going to put them into practice here in just a few minutes. The engulfing patterns. These are some of my favorite patterns. The engulfing pattern is going to happen during a downswing or an upswing, depending on which one you're looking at. But in a downswing, it's going to occur when you have a white candle that totally engulfs the former day's dark candle. Okay, so again, you got the black-white alternating. The first day is going to be a small little spinning top here. Second day will actually gap down, and we will totally engulf the preceding day's small spinning top candle. In the case of the bearish engulfing, that's the bullish engulfing. In the case of the bearish engulfing candle, we'll be in that upswing there. We'll have a small little white spinning top, and the next day we'll have a large black candle that totally engulfs, meaning it totally takes over the size of the preceding small spinning top. Now, big question always happens, does it have to engulf the entire candle, the upper and lower shadow, or just the real body? And technically speaking, I would say it's just the real body, but very, very often it actually engulfs the entire candle. So, technically we're looking for the real body being engulfed there, but, if you get the whole thing, more power to you. All right, this is a very strong reversal signal. It's one of my favorites, very, very powerful reversal signal. In a bullish trend, you have the bearish engulfing, and very, very often leads into a bearish reversal there. In the case of the bearish trend, you have the bullish engulfing. That's the one you see here on the bottom. Very, very often leads into a bullish swing. The entire day's candle must be engulfed for the pattern to be true. And when I say the entire day, I should have specified in here the entire day's real body. Okay, real body. Not specifically the upper and lower shadow. All right, this is a very strong reversal signal, especially when it occurs in the right location, which is support or resistance. You are going to be very happy that I taught you that pattern. It's a good one. All right, now let's talk about the counterattack patterns. Counterattack patterns are an interesting little pattern here. Again, you're going to have the alternation of colors. You have the bullish and bearish counterattack, kind of like the engulfing patterns. In a downswing, here's what happens. We're going to have a white candle that's going to come against a long day bearish candle, but it's going to fail to push into the former day's price range. So in this particular example, you see we traded down, we actually gap down, and then we trade higher, but we do not push into the previous day. Now, in a perfect textbook world, they share the exact same close back-to-back days. This example, it looked right on paper, but then once I'm seeing it on the slideshow, it's not quite perfect there. You see that. But just imagine this one's extended just like that. All right, so in a perfect world, they close exactly the same place. Now, what I will do is I'll fudge it a little bit. If this particular picture here, I would say that's a counterattack. If it came on in and it pierced just a little bit, I'd call that a counterattack. But the idea is you've pretty much got the same closing price between these two candlestick days. Now, in the case of an upswing, it's the opposite. You're in the upswing here. You have a good-sized white candle. The last day or second day of the pattern here, you gap up, and then you trade against the previous day, but you never close. You don't close inside the previous day. This one's even worse the way it's stretched out on the screen here. Sorry about that. But that should be coming against basically the same price as the previous day. What this shows in both of these cases, it shows that the previous trend, it started the morning off really strong and then it basically puckered out. You know, these candles, by the way, they can have shadows. It does not matter. They don't have to have shadows, or they can. They do need to be pretty good sized candles. You don't want them to be spinning tops, but you know, if they're at least average or ideally long day candles, it's even better. But in this case, the bullish one here, the bullish swing, the bearish counterattack, take a look at this. You're in a bullish swing here. Stock's trading up, up, up. We gap up. Now, if you're watching this thing early in the morning, you're thinking, hey, this is awesome. And in fact, a lot of times what will happen is you'll actually have a bullish candle initially that'll shape up like that. Then by the end of the day, what's happened is the bears have come back in. All of the bullishness is gone, and the bearishness has driven this thing all the way down, and we end up with a counterattack. Man, what a strong signal of sentiment. I mean, if that doesn't tell you that the bears totally won this game, you know, what does tell you that? It's just absolutely a perfect signal for you to tell you and to reveal the change in sentiment there. So that's the bearish counterattack. Now, this pattern's technically not as strong as a bullish piercing or a dark cloud cover, or it's not as strong as the engulfing pattern, but it is a very strong pattern. Usually what we see is a day or two later, the bearishness continues and the bearish counterattack, or the bullishness continues, and then we're setting ourselves up nicely for the reversal, and that's what we're ultimately going to be trading, is that reversal. Okay, so that's the counterattack patterns. Now let's look at what we call the harami patterns. The harami patterns, these are kind of the inverse image of the engulfing pattern. Again, you're going to have the white, in the case of a bearish harami, you'll be in a bullish swing, have the white candle followed by the black candle, but instead of having the first day be a spinning top, the first day will be a good long day candle, the second day will be the spinning top. So that's where it's the reverse image of the engulfing pattern. And so instead of the second day engulfing the first day, it's the opposite. The first day kind of engulfs the second day. This technically is what we call an inside day, meaning that the entire trading day happened inside the previous day's trading range. And this becomes a reversal signal as well. In a bearish trend or bearish swing, we've got a good-sized black day candle here, and then we've got a little small spinning top inside there. That becomes the inside day. Again, it's going to be black candle moving to white. And the way that these particular patterns work, they're very interesting. Technically speaking, they are reversal patterns from a pure technical standpoint, but they're kind of a weak pattern. It's one of the weaker candlestick patterns that we look at. And when I say it's weaker, it's because what people always want to see, you know, when you see an engulfing pattern, for example, you're doing this and you got a little spinning top, and then you got a big old black candle that engulfs the previous day there. And then the next day, you know, the bears come rolling in here. And everybody likes that because it's nice and clean and it's neat. With the harami patterns, it's not always neat. A lot of times what you see with a harami pattern is the trend changes into a sideways move rather than a straight up reversal. And so that really frustrates people a lot of times. But I still contend it's a very powerful pattern, because if you're in a trend, you're in a swing, and you really believe this trade's going bullish, for example, and suddenly you get a bearish harami, and that might be telling you that this trade's going to go sideways or down. It's one of the two. Well, it's definitely telling you it's not going up. And so that's a good piece of information to have, especially if, for example, you're trading a call option and time decay is going to become an issue for you. Well, you need to know if it is going into a sideways move. So the harami pattern, while it doesn't always reveal a straight up reversal, what it usually reveals is, more often than not, it does signal a move into a sideways pattern, if not a full-on reversal. And so that's why it's a very, very powerful pattern for us to have. It's a good signal to have. It's a good signal that the preceding trend certainly has stalled if it's not completely reversing. And what that inside candle does is it reveals a loss of momentum from that preceding trend or the preceding swing. And so that's one of the reasons that we really like this pattern as far as giving us the sentiment of what's going on. Again, the thing that you're seeing with all these patterns is you're seeing that formation. In a bullish swing, you have that white candle followed by the black candle, and then that thing reverses. In the bearish swing, you got that black candle followed by the white candle, and the whole thing reverses. So the Harami pattern sticking with that candle formation, that alteration of colors there, and now you're just getting some more details in terms of which formations lead which directions here. Now there is a variation of the Harami, and we call it the Harami cross. And the only thing that really happens in the Harami cross that's different is that second candle, instead of being a spinning top, it's a doji candle. And when you have a Harami cross, the Harami cross is a very good, solid reversal signal. More often than not, the Harami cross does reverse compared to the Harami. The straight Harami very often, it just goes sideways and it could continue, or who knows what may happen. But with the Harami cross, if the next day or two the market really stalls out, it usually plays into that reversal. It's just a stronger reversal because we got the doji in there instead of just the straight up spinning top candle. All right, so those are the Harami patterns. Now the next one I want to look at is what we call the tweezer patterns. And the tweezer patterns, I really like these patterns. Interestingly enough, the statistics aren't that great on these patterns, but I have found that they work quite well. I'm going to show you how I use them. What happens with a tweezer is they consist of two or more candle lines with matching highs or lows. In the case of the tweezer top, you're looking for the matching highs. In the case of the tweezer bottom, you're looking for the matching lows. Okay. Now, here's the interesting thing. The candles have to alternate, just like with all these other patterns. Tweezer top alternates white to black. Tweezer bottom alternates black to white. Very often it does turn into a reversal signal. But here's the thing that gets interesting. To meet this criteria is not very hard, because you can have all sorts of variations in here. For example, in a swing, you could have the first day's candle that looks like this and the second day's candle that looks like this, and you have met that criteria of matching highs. So that may or may not turn into a really solid reversal, even though in this particular case it probably would, because you got that shooting star. But just as easily, you can have this formation where you had a hangman up there, and you say, well, maybe that's going to reverse or maybe it's not. And, if you look at this and you say, man, I got a good, strong, bullish white candle followed by a hangman where I've got all this bullish pressure from that lower shadow, there's a good chance that thing's not going to reverse. And so, technically speaking, you can have all sorts of variations to meet this criteria. What I have found is if I go with any candle pattern that meets this criteria, it's not very consistent. But if I go with the formation as I've drawn it here, where you have two good-sized real bodies, and they're matching highs with the alternating color like this. And yes, you could have a little shadow up here. That's fine. But what I really like is when I see this particular picture. And again, technically, it's not the only tweezer. There's variations that can still qualify as tweezers. But when I see this particular variation, when I'm in an upswing here, I get a good, strong white candle. The next day, I get a good, strong black candle. I feel like that tweezer top reverses very consistently, and I really like that signal a lot. Same thing with the case of the tweezer bottom. You're trading along, you got a good solid white candle the next day. You know what? This is backwards. I just realized that these candles are backwards. This first candle here should be black, and the second candle should be a white candle. We have to make that note for our notebooks there. So moderators, we got to make that note somewhere so we can get back there and change that. I'll make sure Paul gets that changed right after class here. Anyway, so you guys get the idea. It should be the downswing here, black candle followed by a white candle. That creates the tweezer bottom. Again, it turns into a really solid signal when it's this particular formation. If you got one of those awkward variations where maybe you have, see, technically you could have this little variation right here, and it would be a tweezer bottom. It would also be a bullish engulfing candle, but that would technically be a tweezer bottom as well. And so, the idea there is just that if it's got the same highs and lows, it's a tweezer. It really kind of represents a very fast double top or double bottom. But when I see these particular formations, that's when it really works a whole lot better, in my opinion. And so if you watch for that formation and that kind of packaging of it, I think you're going to be a whole lot better in terms of packaging these things together. All right. Sorty says, can you show an example of alternating from black to white? Sorty's, I can't redo this image on the fly, but what I can do is I can color it. So just imagine that the red is black. You see that there's, and then when we go to the Trade Navigator, we'll try to find some real examples. But, you know, I drew that in there. That's an example. Maybe it's not as perfect, but it's an example. You can imagine what it should look like. Puri says, how strong is that tweezer? Tweezer is... you know, again, statistically speaking, they say it's not that strong, the people that have done the statistics on it, but it's, in my opinion, it's because they don't look for the ideal ones. See, for me, I feel like my statistics work better, at least for my trading, because I'm using them in the ideal format. And that's what I'm teaching you guys, is the ideal formats. And whenever I see them in this ideal format, I think they work exceptionally well. I would say, you know, certainly over 60% of the time. At the very least, that would make sense to me. No, it doesn't really matter if they have upper and lower shadows. I do like this. I mean, the way that I've drawn it here, that's what I love. If they're about the same size candle formation with alternating colors, that's what I really love. Those are the ones that really seem to work the best. But again, technically, they just got to have the same highs or the same lows, same highs for the tweezer tops and same lows for the tweezer bottoms. All right, now let me show you one of my favorite patterns, one of my old favorites. This is one that I actually kind of discovered on my own. None of the official literature, but Steve Nissen and some of the main writers actually talk about this pattern. And I kept noticing it, noticed that I never had a name for it, noticed that it always reversed, did a lot of research, named it myself, and then came back and discovered that actually Greg Morris had done some research and discovered the real name for this pattern. And we transliterated it into the one white soldier pattern. So what is a one white soldier? One white soldier is going to happen in a downswing. You have a large black candle that appears, and the following day you've got a white candle that appears. Now watch what happens here. The candle gaps up, so it opens higher than the first day's close. So first day closed down here. Second day opens up here. Opens higher than the first day's close, and it closes higher than the first day's open. So we close up here. Okay, so we gap up and we close above the previous day. Now, yes, you can have shadows in here. I don't care if you have shadows in there. It's not a problem. But the real body is what we're looking at here. Real body gaps up and it closes above the preceding day. This is a super, super strong bullish reversal signal. Watch for it at a support level. I don't know why it says, oh, sorry, it doesn't, it said it right there. Watch for it to appear at a support level. I'm looking at my next slide accidentally and it said resistance. Watch for it to appear at a support level, and when that happens, this is just a solid, solid reversal. We'll find some examples of this when we get over to Trade Navigator, and you'll see it here. All right, now let's look at the variation on this. This is the bearish variation. It's called the one black crow, and this is actually the one that I had noticed before I discovered the one white soldier. The one black crow is the one that I had been tracking and following. It's the same formation in an upswing. We got a large white candle that appears. The following day, we got a black candle that appears, which opens lower than the first day's candle. So first day's candle's closed, that is. So first day candle closed up here. New day opens here. And then we close lower than the first day's open. So first day opened here, and the new day closes down here. So you can see what happens. It's just like it's jumping off a building. You can see that right there. And so that is the one black crow. Again, it's a super, super strong reversal. I think of all the patterns that we've talked about so far, this is probably the one that's the most consistent in turning into a reversal. The bearish and the bullish engulfing patterns are very, very strong as well. The engulfing patterns I used to think were the strongest until I really started looking at these patterns. But these one black crows and one white soldier patterns are very, very strong, and you should learn to recognize them when you see them in the market. Very, very good patterns there. Okay? Let's move into, these are all the two pattern candles that we're going to be talking about. Let's move on over here into three or more formations. And I've only got a couple here that I really want to share with you. I've got the morning star pattern. The morning star is going to occur during a downswing, and it's going to take on this basic formation right here. You'll be in a downswing, At or near support level, you've got an above average black candle. So this is an above average size black candle. You have a small gap down on day 2 with a spinning top, and that spinning top becomes the star. Notice the little small gap right in here. Okay, so you got a small little gap down, and then day 3 is a good size white candle. And what I want to see with that third day is I want to see it go at least halfway into the preceding, to the very first day of the pattern. That's what I'm looking for. Now, if it goes the whole way or more, that's even better. But if it doesn't go at least halfway, it's usually not as strong. Now, in a perfect world, that second space here would also be a gap. That's the idealized, very, it's not that common that we find that. But this basic formation we find quite often. Relatively speaking, it's pretty common. And it turns into a reversal pattern, a bullish reversal. Very good at support. Now, one of the other things I want to point out about this pattern, technically speaking, this little star right here technically can be black or white. It doesn't matter. Okay? But what I have found is if you go black, white, white, it works better for the bullish reversal. That's what I have found. Okay, now, again, technically to be a morning star, it can be a black, black, white. Doesn't matter. But if it's a black, white, white, I have found that it's a stronger pattern, and I like that better for the morning star reversal. Now, if you turn that upside down, you've got the evening star reversal pattern. And again, it's the same kind of concept here. We'll be in an upswing. We'll be at or near a resistance level. We get an above average size white candle. We're going to have a small gap up next day, and we'll end up with a gap in here, a small true gap, okay? And then on the third day, we've got a good-sized black candle, which comes in and moves at least halfway into the first day, right in through here. Again, I prefer to see, in this case, white, black, black. Now, again, you could have this middle candle could be black or white, but, if you can find it in this formation, which is not uncommon, it's very common, actually. You find in this formation, this evening star pattern is a very, very good reversal signal. Very, very strong. That's the one that I showed you the opening of the class here tonight just a few minutes ago when I said, what is this right here? Are we bullish or bearish? Right in the middle of a bullish trend. Right in the middle of a bullish trend, out of nowhere. We got these 3 days right back to back. Looked like this right here. I said, that sets us up for a bearish swing. And, of course, once I revealed to you where the trade went, you could see, after all, it was a bearish swing. All right, so evening star reversal, very, very strong pattern. Now, there's a couple of variations of the star patterns here. We call them doji stars. You've got the evening doji star and the morning doji star. All of this means there's nothing fancy to it at all. All it means is that second candlestick in the formation is a doji instead of a spinning top. That's really all it means. Nothing fancy about it. It's a little bit stronger because of the doji, but nothing other than that is really specific about the pattern. All right, let's talk about a rest after battle pattern. This rest after battle pattern is an interesting pattern. It's going to occur during an upswing. You're going to have a large white candle, and you're going to be followed by 2 or more small candles, which basically trade sideways, thus creating that chart pattern that we talked about a few classes ago that we called a stair step. Okay? Now, so basically a stair step pattern very often forms like this, but there's a specific look I'm looking for with the candlesticks. I want that big white candle, a couple, 2 or more. So it could be 2, it could be 3, it could be 4, it could be 8, it could be 10, doesn't matter. 2 or more sideways small candles that are basically inside that first candle. And then on the final day, whichever day it comes, we get a large white candle. Now, this formation, we technically call it a rest after battle, and it's basically a candlestick version of a stair step, but a stair step does not have to have these candles. A candle rest after battle has to have this formation. When you see it, it's an exceptionally strong bullish continuation pattern. I mean, it's got a very, very high follow-through rate for being a good reversal pattern or a good continuation pattern for us here. The thing that I really want to drive home with this pattern, yes, I want you to look at that, but what really I want to drive home is this formation of a large white candle followed by several small candles, and they could be black or white, it really doesn't matter. followed by the large white candle. If you look at that idea right there, notice what's happened. We've got a lot of bullish pressure, indecision, followed by a lot of bullish decision. Okay? I like to say that these are kind of sandwiching the indecision. You've got strong bullishness that's sandwiching all that indecision, and that really creates an awesome, awesome continuation pattern. And what you're going to notice, even though there's maybe not a name for every pattern, when you see that formation, that is a green light. That's a really, really good continuation formation, even though there's not always a name for it. And that's what I really want to drive home. It's not about the rest after battle name. In fact, most of these patterns, I don't care about the name. I just want you to understand the sentiment of what's occurring here. And when you see this formation, it's a really, really solid formation there. Now, interestingly enough, there is not a specific bearish rest after battle pattern. That's interesting. I don't know why, but there's not. However, the format and the basic idea works the same in a bearish pattern. There's just not officially, in the world of candlesticks, a bearish rest after battle. But, yes, it will work if you had the same basic idea. Again, this would just kind of, in fact, if I was writing all the books for candlesticks, I would just call this a bull sandwich and a bear sandwich. That's really all I want to see there. If I can see those outer candles showing that sentiment, I've got the picture, and that's what I'm looking for. Okay, now let me show you a couple specific ones. We've got the rising and falling 3 patterns. These are very specific rest after battles, and they are very strong continuation patterns. The rising 3 is going to be that little sandwich formation that I just talked about. You got a large white candle on the either side of the outside, and in the middle, you've got 3 little small spinning tops that do not close below the first day's candle. So none of these spinning tops can close below the first day. Now, I've seen many of these where the shadow went down, but the formation didn't close, and they still worked out just fine. I'm telling you what, this is one of the strongest continuation patterns you're going to find. It's an excellent, excellent formation. And really, I mean, the reason it's such a strong formation is because it's a rest after battle in essence. I mean, it qualifies for a rest after battle, but it's a very specific one. We call it a rising 3. If there was 4 candles in the middle, we'd just call it a rest after battle, but technically it'd be kind of like a rising 4. And I love this formation. It's just a very, very good, solid continuation pattern. Gives you really good insight of the direction the trade's going to be going and breaking out into. Okay? Now, let me look at this. This is the bearish version of it. We actually have a bearish version of this, even though there's not a bearish rest after battle. This is a bearish version of the rising 3. We call it the falling 3. And you kind of got that sandwich idea again. You got those 2 black candles sandwiching 3 small candles on the inside that do not close above that first day's high. Now, those inside candles, I don't care if they're black or white. I'm just telling you, though, if this formation, you see it like that right there, that is the most ideal. When you see a strong black Marubozu on the left side, 3 small little white spinning tops, and then another big black Marubozu, my gosh, what a great bearish continuation pattern. I've never done a statistical study on it, but it's got to be in the high 80s or low 90s in terms of how consistent this is with playing out. And it makes sense because those statistics that we had for the stair steps put it in the flag patterns, put it up there in the high 80s, low 90s for breaking out consistently in the right direction as a continuation. So it would make sense that these rest after battles would continue in the same kind of consistency. Very, very good continuation patterns. Okay, there we have it. I can't believe it. In 45 minutes, see, I combined 2 candlestick classes from the Legacy program into one. I didn't think I could do this in 45 minutes. I got through all of those in 45 minutes, which leaves us about 45 minutes to go over and look at some examples. Before we go look at examples, why don't I give you some homework just in case some of you need to go, and then if you need to shut down the webinar on your end, you can get out of here just a little bit early. But here's your action steps and some homework, and then we'll go over and we'll look at some of this stuff in the real world. Here's your action steps. Study several charts and work on identifying patterns. Watch how your stocks respond to the current candle patterns that are getting formed and work through the quizzes. Those quizzes are really going to help you solidify the principles that we've been talking about and whatnot here. Okay, so now let's just make a quick note of those action steps. I'm going to take a quick drink, then we're going to get over to Trade Navigator and do some hands-on analysis in some real charts here. All right. Edward says, what happened to the belt hold candle? Well, I left it out, Kevin, or Edward. I left it out because I really didn't find that we were identifying them that often. And, you know, there's a couple formations I left out. I left out the three-line strike. I left out the mat hold. Left out a couple of formations that we really don't see that often. And what I'm trying to do is streamline the efficiency. If I can get you guys to recognize these 2-day patterns and the 3-day patterns, just the evening and morning stars, and just the basic idea of the rest after battle and rising and falling 3, if you guys can just identify those basic formations, that's really going to make you a whole lot of money. And that's really what I want to do. I want to streamline this rather than helping you guys feel overwhelmed. I want to help you guys feel like you can accomplish and achieve it. And so that's really what I'm shooting for there. So Edward, if you really want to study that belt hold formation, be my guest. I think in the last couple of years, I've only run across a handful of them in common practice. So that's why we ended up not including them. Okay. All right. Let's move into some analysis, and let me address Kevin's question. Kevin says, do these patterns work intraday? And Kevin, they do. There is one small adjustment, Kevin, and I'm going to let you guess what that is. Do you have any idea, Kevin, what the adjustment would be? Very, very small adjustment, but very, very important. Any idea? There's no gaps. A couple of you have written it in there. Kevin, I never saw write it in. Oh, yeah, Kevin did. He said, no, he has no idea. Kevin, here's the difference. There's no gaps intraday. In fact, I will start intraday. Let's go into an intraday chart here. I'll go down to like a 5-minute chart, and I will find some of these patterns for you, and you're going to see that there's no gap in the day because the day does not, there's no closing price, so you can't really have a gap. Take a look here at this tweezer top that should be an engulfing pattern right here. Okay, it looks more like a tweezer top, but technically it's an engulfing pattern. See, we basically had the same open and close right here, but we engulfed the preceding day, or the preceding, in this case, 5 minutes. But there's no gap because the market never closed. And so this is what you're going to find in Forex charts, and what you're going to find in intraday charts, Kevin, is you have to adjust the formations just a little bit so that you can get to understand better what's going on. Just adjust the gaps out, basically. Everything that should have a gap doesn't have one. Yev says he sees a gap. No, you really don't. That's a tick. It's a 1 tick higher. It's not a regular gap. It was just that we were in a strong bullish swing here, closed at this tick. Next tick was 1 tick higher. We traded all the way up to here, and then the bears came in, engulfed that preceding day there. It wasn't even a spinning top, and it still engulfed it. So that really showed a lot of bearishness. And then during this bit right here, we've basically been consolidating in a little bit of a flag pattern. Take a look at that. We're not talking about intraday trading at the moment, but you can still see those formations that we've been talking about. All right, let's get in here. I'm going to go to some daily charts. I'm taking my lines off so we can really identify patterns. I want to start with Apple, because on Apple we've got some really good, interesting formations that have occurred. Most notably yesterday, notice what happened. We were in a strong bullish trend. Look at that, strong bullish swing here. Had a good, strong white candle, gapped up, and then traded down yesterday. What would that candlestick formation be? Forget today's white candle. What would yesterday's formation have been? That would be, okay, Joe said piercing, and Joe, I'm going to give it to you even though it's not the right answer. The answer is a dark cloud cover, okay? But what Joe did get correct is the idea that it's piercing, and the truth is a dark cloud cover could be called, even though it's not called this, it could be and probably should be called a bearish piercing pattern. And I wish it was called that because it would make it a little bit easier to remember if we had a bullish and a bearish piercing. But it's called a dark cloud cover. And when you see a dark cloud cover, the dark clouds are starting to form. And the idea is that it's going to rain soon, right? Well, that's what the Japanese said about this market. They say, hey, everything's been looking good, but suddenly we got dark cloud cover. Looks like things are about to roll over. Well, did they roll over today? The answer was at the beginning of the day, yes. We opened down here, traded down, but we never kept going. We basically filled that gap from yesterday morning, or 2 days ago, however many days ago that was. We filled that gap, and then the bulls came rushing in. Now, isn't that interesting? Based on our gap discussion that we had a couple weeks ago, remember how we talked about most gaps get filled very quickly? Well, watch what happened here. I'm going to zoom in really, really close so you can see it. In this particular trade, Apple was so optimistic that we gapped up a little bit right here. We traded very, very bullish, made all-time highs for Apple, and then yesterday we gap up again, made higher all-time highs, all the way up here to 675. The bears said, no, it's too good to be true. Started selling, and where did we go? We ended up by the end of today, or by the first part of today, opening here, selling down to exactly that gap level, filled the gap, and then the bulls said, okay, we're okay. This actually takes the bearish dark cloud cover, and this is why I call this application, because you always have to keep candles in context. Yes, we're in a bullish swing. Yes, it's a dark cloud cover, but in this context at this time, what could have been a very good reversal pattern has suddenly turned into most likely a consolidation or a continuation pattern, as the bullishness was rushing along and we're shaping up to possibly have a sideways flag type of a pattern through here, either a flag or a stair step or something. What you're going to do in a formation like this is you're basically going to set your trigger above the high from yesterday and below the low from today. That would be a bullish entry. This would be a bearish entry, and you'll probably get both of those to work correctly. In all likelihood, the momentum would suggest that the bullishness would work. However, the fact that this trend has gone a good ways here, good distance, we moved from 570 all the way up to 670. So a $100 swing in less than a month on Apple. Because of that extreme move, there is a good chance that we might get a slingshot effect and the bearishness could really come rushing in here. So that's how you would set up a bracket trade on something like this particular trade here. Now, let me come back a little bit further here, show you some examples of where this did not fill out the same way. And I want to come back to April, which was the end of this particular trade on Apple. Apple had been moving very, very nicely. We've been getting all sorts of bearish divergence and other signals that you'll learn about coming up. And right at the top of this trend, look what happened. We got a good strong white candle. Next day, we got a bearish dark cloud cover. There's your 2-candle pattern right there, dark cloud cover. The following day, instead of having a white candle like we had today, what happened? We got a bearish candle. This thing started to roll over, and boom, the bottom fell out of it. We went from 625 down to 575, actually almost to 550, but we'll just call it 575 in a matter of days. And you can see that there, how fast that whole thing rolled over. We gapped up, we tried to stop it, but in the end, this whole thing, by the time the next month was done, we had made it all the way to the bottom here and given back over $100 worth of swing. So the volatility on Apple started to really pick up, but we needed it. We needed a big corrective move there because it had gone so far. Now, I think it's interesting to see that dark cloud cover set the whole thing up. Okay, it's also interesting to go back about 2 weeks before that. There was another formation that looked like a dark cloud cover. It was a dark cloud cover right there. And this one did not play out as a bearish reversal. The next day after the dark cloud cover, we got a small candle that was an inside day.